It's the worst in 50 years. I'm your host, Steve Metre, and thanks for joining me today. In our lead story today, we have an alarming development as a new report is now confirming our worst fears as slowing global growth signals big trouble. Let's over to CNBC, where he picked today's story up with a headline: World Bank sees major economies growing at a much slower pace thanks to higher rates and banking stress. And this is just kind of towing the party line of what we've been hearing from policymakers and central bankers, that we're going to see a soft landing or no landing. This issue with the banking stress and the consumer prices, it's going to abate at some point, but thanks to higher rates and the quick reaction of central bankers, this is all going to be a problem and a story that we're going to look back and say, thank you, central bankers, for fixing it. But what they don't realize is that this slowing growth is actually going to turn into a global recession. The institution said advanced economies, the U.S., Japan, and Euro area countries, are expected to grow by only 0.7% in 2023, down from 2.6% in 2022, again following all of that pandemic and monetary stimulus that got injected into the global economy. The U.S. is projected to grow at 1.1%, while Euro area and Japan are projected to see GDP growth of less than 1% this year. And then when you look at GDP, and this is kind of important to understand because, again, the broad narrative is the U.S. is just going to see a slowdown. Now, the question is, how do we get from a slowdown into a recession, or even worse, a globally synchronized recession? Well, one of the key ways we can look at this is new order demand, because in the economy, when new orders start to go down, well, that's an indication of falling demand, and eventually it means that we're going to see a broad increase in layoffs. And as we see people hit the unemployment line, well, it means that their wages are going to fall because their unemployment checks do not make them whole. And in turn, all you see that translates into is a continued decline in demand and consumption. So when we look at this next chart, as we look at new orders, the question we need to address here is this rebound we're seeing actually sustainable, or are we about to see another major downturn in new orders? And if we do, well, that's going to make the case, as you'll see in a bit in the show, that GDP growth is going to go well below the World Bank's 1.1% target. Here you can see we have GDP in red against the Philly Fed diffusion index for new orders in blue. Now, keep in mind the new order index is noisy. It moves around a lot. And that green dotted line across the bottom, well, there's the 1.1% GDP growth. So what the World Bank is saying here is right now the U.S. is decelerating. It's going to continue to decelerate back down to, below trend of what we saw during the last cycle, kind of into what would look like a soft recession here. The cases, can this thing go negative? Well, on the onset, we're seeing a rebound in new orders. This would look pretty good, but we can note going into past recessions, there has been a rebound in new orders, and then it further collapses. So if we start to see a turnaround in new order demand, which we could argue now that the budget has been passed, what are we going to find out is, of course, we already know the answer is that student loan repayments are returning. This is going to be a huge drag on the economy. We know that higher interest rates in a world of a large amount or a record amount of debt is a drag on consumption. So the odds are we're going to see a downturn. If we do, I bet we're going to see GDP fall well below 1.1. The bank estimates overall global growth will deteriorate to 2.1% in 2023, down from 3.1% last year, and that would be a good sign if it was only that slow, as emerging and developing economies are forecast to see a slight uptick in GDP to 4%, up 0.6% from the bank's projections made in January 2023. But however, that may not last, as the World Bank chief economist said, excluding China, growth in developing economies would be less than 3%. And I think this is optimistic as we look at some more of the data. As they note, this marks one of the weakest growth rates in the last 50 years. And that's significant because we've been told that we're on the onset of another big bull market in stocks, that we're going to see the next big economic cycle is here. And all of a sudden, the data is starting to say maybe none of that's going to happen at all. The reduced forecast for growth reflect broad-based downgrades stemming from several overlapping shocks, most recent which include spillover effects from the recent banking crisis seen in the U.S. and advanced economies. And this is a key point here because the broad view is, hey, we had a few banks fail and we did some things about it. And look, we put a firewall around it. We contained it. Everybody came to the rescue and it's all been solved now. But the actual reality of the story is the banking stress that was there is actually getting worse, and we have actual data to validate that. And my concern is if we do see a marked slowdown in the economy or a further slowdown, that is only going to be a matter of time before that more banks start to fail. I would love to get your opinion on that. Do you think the banking crisis is over, or do you think that was just the first round of many more to come? Because if we head over to the Fed, this is the H.1 report, or H.8, or Ford report. There we go. Here we can see the Bank Term Funding Program, BTFP, is now up to $100 billion in usage. This should be drawing down, my friends. That's how you can tell the stress in the banking industry is going away, is when usage of these programs goes down. If you see it going up, along with what we're seeing is continued monies flowing out to money market funds, it suggests that the problems in the banking system have not gone away, and all the policymakers have done is slap a Band-Aid on it. Increasingly restrictive credit conditions resulting from the banking turmoil have effectively shut out emerging and developing economies from global bond markets, putting them in dangerous waters. Well, the problem with credit conditions is it's going to cause GDP to come down too. So if we look at this chart, one of our favorite charts on the show is the net percentage of domestic banks tightening standards for commercial and industrial loans of all sizes, or banks of all sizes. This is the blue line, and anytime the blue line peaks above the horizontal black line, even if it's coming down, it means banks are on net tightening lending standards. In red, we have GDP. I put that mythical 1.1% line that the World Bank says is the target it sees. And I want to point out that anytime you see a marked tightening in lending standards, GDP comes down. Here you can see in the global financial crisis, it went negative. And here we saw it during the pandemic, obviously went negative for other reasons than just a normal recession. But now we're seeing lending standards stay tight. And notably, when we go back and look at the last senior loan officer opinion survey, this is published by the Fed about every quarter, what we saw is these loan officers told us that they anticipate tightening credit conditions through the end of the year. That tells us the odds of GDP growth going negative are pretty high. Nonetheless, central banks around the world continue raising rates to fight off persistent inflation in the hopes that higher interest rates will actually deal with inflation. Instead, they seem to be damaging the banking system as the world economy remains hobbled, the bank said in its report. Besieged by high inflation, tight global financial markets, and record debt levels, many countries are simply growing poor. And one thing that shouldn't remain hobbled, well, that's your trading account. And it should not be getting poor, because if you have CTA-Timer Pro, you already knew that it gave us signals back here as this tech rally is just starting to look like it's going to go vertical. We'll have an update on this tomorrow's show, but I told you to start buying back here. I told you, look at this, it's deeply short, but look to buy. And if you missed it, it said buy this pullback, and you could have seen this rally. Here it is, back to the January 9th report. This thing was deeply short and started to cover. We showed you this in the reports back then, and now look, on March 15th, we saw that pullback. The machines started buying out of that, again, giving us all the indicator. And for those of you who are subscribers, we just put up the weekend watch list. I went through the whole report, showed you which ones right now are at the low point. Again, this runs a model against the machines and then a historical overlay to find the lowest ones out there for you to put your signals on to catch the swing up. Again, $30, link in the description below. Check that out. 30-day risk-free money back guarantee. So let's take a look at these financial conditions again relative to the consumer price index, because the belief is that if central bankers need to keep raising rates to deal with inflation, when the banking system is going to do that for them. Here you can see that when banks tighten net lending standards on net, what happens is you see the inflation now in red roll over and head down. And it's come a simple really explanation here, because in a debt-based economy, we need the creation of new money, not only to pay on old debt, debts, but to create economic growth. So when the banks pull the throttles back and stop creating new money by not allowing new loans to be originated, you have less money in the economy. Of course, that less money needs to go to debt payments, less money then for new growth, which means less spending. And then all of a sudden, the whole system starts to unwind. And if there's a big enough pullback in credit creation, well, what you then get is actually a financial crisis. Here you can see during the global financial crisis, banks had tightened lending standards so much that inflation came crumbling down and went into deflation. We saw it again during the pandemic, for obvious reasons, and we're seeing it now. And again, banks are saying they're going to keep lending standards tight. Inflation is going to come down. There's virtually nothing that the central bankers have to do at this point other than sit back and watch. And here's some evidence that the global economy is getting worse as China deflation risk prompts PBOC governor to downplay fears, because here we've gone from this, we're going to have super high inflation, big economic growth, huge stock market gains, and all of a sudden we're seeing deflation out of China. And this is a big problem because if you think about, what countries do in the world, the U.S. exports inflation by exporting dollars. China exports deflation to the rest of the world. So if we start to see deflation in China, it says the rest of the world's got no chance of sustainable inflation. The consumer price index rose 0.2% from a year earlier, according to government data, in line with forecasts. But producer prices, and this is important, declined 4.6% on the back of lower commodity prices, which we just talked about in the show the other day, and weak domestic and foreign demand. Also, when we covered in our China Super Show, economists had expected a 4.3% decrease, meaning it is deflationary. It went negative. Here you can see in this chart, the CPI there in China is going relatively straight across, unchanged. But look at producer prices. They are now negative. And this is important because when we look at this next chart, the Fed database has producer prices for economic activities total for China. Now, doesn't have the latest print in it. I looked for it. It did not have it. But notably, when we overlay the consumer price index in red, you'll notice there's a very strong relationship. As I said, China exports deflation. So as China's producer prices go negative, you'll see that they backfeed into, with a lag generally, into U.S. consumer prices, telling us one very important thing. Again, not only due to the banks, but due to China and other factors, we notice energy prices as well, that the U.S. is not going to continue to see high inflation. I know many of you disagree with that, but the possibility that when we hit in a recession that we're going to see outright deflation, well, those odds are getting higher. The risk of deflation is still weighing on the economy as recent economic indicators send consistent signals that the economy is cooling. Very obvious. We see it all over the place. Here in this story as well, charting the global economy. Weak trade shows China is struggling, and not just China, the entire world. In Germany, a major exporter to China, another decline in orders placed with manufacturers suggested a lack of momentum in Europe's largest economy. Meanwhile, consumers in the Eurozone became much more sanguine about inflation outlook, a development that feeds into the debate about how long interest rates must rise. So here you see policymakers saying we must raise interest rates even more and more and more, and everyone else is going, well, maybe we're not quite seeing all the inflation lasting that you think, and perhaps what we're going to see is a case we've been making on this show and with my friend Jeff Snyder on his show is that at some point central bankers are going to be massively cutting rates as they race back down to zero. China's economic recovery showed further signs of weakening in May, clouding the outlook for the rest of the year and fueling calls for more central bank stimulus. Trade figures this week were the latest to show the economy's weakening outlook. Both exports and imports contracted in May from a year ago, a sign of subdued global and domestic demand. And this is a time, my friends, when we're not just seeing subdued demand from one country, we're seeing it from all countries. And that's the risk here, is that we're facing a global synchronized economic recession. At that point, central bankers around the world could go to zero, and it's not going to change a thing. Calls are growing for the People's Bank of China to cut interest rates. No surprise, the Fed will be getting the same call here in a matter of months, with a prominent economist and government advisor, the latest, to argue for more easing. Here we can see they have said they would lower rates to alleviate financing burdens on private businesses and boost economic recovery. The only question is, will they actually go forth with that? And speaking of lowering rates or raising rates, perhaps the Federal Reserve may pause its interest rate hiking campaign. What that means for you. Now, the question is the Fed actually going to pause or not? I'm going to give you my take on it here in a moment, but let's see what they had to say. The central bank has raised interest rates 10 times since last year, the fastest pace of tightening since the early 1980s. Only see inflation stayed well above its 2% target, pretty much validating that 10 rate hikes have nothing to do with containing inflation, despite the fact that the Fed wants everyone to believe that they can actually do it, and everyone wants to believe that the Fed actually has that power. And we're living in uncharted territory. The combination of rising interest rates and elevated inflation, while not uncommon from a historical perspective, is an unfamiliar experience for many consumers, particularly those here in the U.S. who have not experienced inflation for a long time, if at all, in their life. A pause is not going to make things better, and there's good reasons, because even with a pause, interest rates are the highest they've been in years. Borrowing costs have gone up dramatically, and that's not going to change. Again, you start thinking about, do people want to buy cars, at 8 or 9% interest rate? Do they want to buy homes at 7%? Do they want to pay, charge up their credit cards? Well, so far they do, even though they're paying 20% interest, but at some point they're going to have to dedicate money to paying those payments. It's going to take away from discretionary spending. It's all going to come crumbling down. Now, as far as my prediction on the Fed meeting coming up, it is next Wednesday. We have the official announcement from them. Here's my view. If they're going to pause, they're going to make a one pause, but talk about how they're just temporarily looking at the data and they think they want to see a little bit more, but they're going to raise at the following meeting. They're going to be very convicted about the next meeting is almost a lock for a hike. The other thing is they will hike now and then act like they're going to pause and watch the data. That's the two outcomes I see happening. No chance that they cut at this next meeting, but either way, whether they pause or not, they're going to be talking future rate hikes in the future until they go cutting back to zero. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.